Now we're now going to make life somewhat more complicated, and instead of just having one variable that's uncertain, we're going to have two variables that are uncertain or risky. And what we're going to do here is joint probabilities. Now what this involves is combining the probabilities of the two different variables. And what we're going to do again is set up a data table, set out all the information in a table, which helps you to understand what you're doing, and also in the exam to show the marker that you know what you're doing. So different company this time, we're in Brown company now, and the different variables that we're looking at are the variable cost per unit and the fixed cost of a particular product. So those are the two uncertain variables. And what we're given is the probability of each particular outcome of both of those things. So the variable cost could be 12, 13 or 14 with its respective probabilities. The fixed costs could be 100, 110 or 120, and again we're given the probabilities. So the first thing to look at is what does that mean for the profit given those different circumstances. So although we've got two uncertain values, we've got the variable costs and the fixed costs that could change, the selling price will stay the same, that's $25, and the number of units that would be sold in this particular time period is 30,000. So what we've got to calculate is a profit for each of the various combinations. So in terms of the calculation of the profit, what you're going to do is take the number of units, which is 30,000, multiply that by the contribution in effect, which is the selling price, take off each type of variable cost, and then take off the fixed costs, and that will give you the profit. So for example, if the variable costs are 12 and the fixed costs are 100,000, we can calculate the profit. So 30,000 times by 25, take off 12, and then take off the fixed costs of 100,000, giving us a profit of 290,000. Now you might find it easier to get rid of the thousands, because then the numbers will be much quicker to deal with, but if that confuses you, just keep the thousands in there. And then you repeat that for each of the combinations. So just to show you the workings for two more, so fixed costs of 110 and variable costs of 12, and fixed costs of 100 and variable costs of 13. So workings for each one, it is a long, slow process, but you need to tackle it carefully and logically, preferably showing your workings if you've got room to do it. Just in case you make a mistake, the marker will still know what you've been up to. So once you've done all of those long calculations, you should end up with a table like that, which shows all the various different combinations of the profit. Ultimately, what we are trying to calculate is the expected value of the profit. And you know from earlier on in this chapter that what you do is you take each level of profit and you multiply by the probability. Now the probability is slightly more complicated here because you've got two variables. So what you do is a joint probability. To calculate a joint probability, you combine the two of them together. So for example, in this case, you take 0.2 times by 0.4 to give you 0.08. In this one, it's 0.5 times by 0.2, and that gives you 0.1. 0.1 times by 0.2 gives you 0.02, and so on. So here's the numbers for you to check yours against. So a simple multiplication exercise really. Just the only thing to remember is that a joint probability means you've got to multiply the two probabilities together. Once we've done that, we can now put that together with the profit that you calculated before to calculate the expected value of the profit.
A decision tree then can be used when we've got several decisions or a range of possible outcomes to consider. So multiple decisions then and a range of possible outcomes. So often more complicated then than the scenarios we've seen with joint probabilities. When we're constructing a decision tree, there are some rules to remember. When we do this, then we have to look then at drawing on all of the possible choices and outcomes. So a choice then is where we make a decision. An outcome then is something which we have no control over. And we'll come back to the differences between those when we start drawing in an example. First of all then, it's important that we plan the tree and make sure then that we tick off all of the information given to us in a question as we use it. Why do we need to plan a tree then? Well, as we've said, there might be several different decisions, and we want to make sure then that we use the paper in the most appropriate way. And that means then we need to follow step B as well, make sure we use a ruler, leave as much space as possible, and we draw it from left to right. As well as drawing the actual tree itself then, it's important that someone can interpret it, so we need to have a key then which details the different symbols. And here then it's going to be important to differentiate between those decisions and the outcomes. Drawing it then from left to right, but evaluation actually takes place from right to left. So we will be looking backwards then and looking at the possible outcomes, which we'll draw with a circle, and then think, what's the best possible decision that I could take at the squares or the decision points? All the workings then will be shown on a different page, and we'll have a look at that again with an example. And what we need to do then is to state what our decision is. So like so many questions then, we need to make sure that we're saying what we think is the best decision after our analysis. Let's have a look then at an example where we've got a decision tree to draw. So Captain Co runs business through a number of centres and we've got declining sales. So here are our three options then. First of all, we can shut down the site and sell it for $5 million, or we can have a major refurbishment or a cheaper refurbishment. And we're given some probabilities about the chances then of these refurbishments achieving good results or poor results. The major refurb is going to cost $4 million now, but you can see that if it does work out, there are some substantial gains to be made. Or we can go for a cheaper refurbishment for $2 million, and as you might expect, the cheaper refurbishment has lower results. What we need to do here then is to construct a decision tree to show all of the possible decisions and outcomes, and then evaluate this to give a statement or a conclusion about what action should actually be taken. So when we're going to be drawing up these decision trees then, we need to leave ourselves plenty of space, and I would always recommend then that you use a ruler and start on a new sheet. So what we've got here then is we need to make a decision, and because it's a decision we're going to put it into a square box and we're going to call that point A. We label all of our points so that we can refer to them, and we've got three basic options at this point. The first option then, and possibly the most straightforward to draw up, is to shut it down. There are no probabilities involved in this. Shut down your site then and you will get $5 million. Or we can undertake then a major refurbishment. So we can go for the major refurbishment, which has a cost of $4 million associated with it. If we decide then, so it's a decision to make the major refurbishment, there are two possible outcomes, and these outcomes then are drawn coming out of a circle because they're beyond our control. So we could have good results if we go for this major refurbishment, and the probability of that is 2/3. If we do have a major refurbishment and the results are good, that will see us have a gain of $13.5 million. Alternative outcome then is that the results are poor once we've had this major refurbishment, so it's not liked by the market, by the customers, and that's going to give us $6.5 million. And we'll call this point here B. The final option then was to go down the cheaper refurbishment. And this cheaper refurbishment then was going to cost only $2 million. Again, beyond our control what happens. It might be that the results are good. And the probability of that again was 2/3. But here the gains are 8.5 million. Or it might be that the results are poor, which would see income rising by only 4 million in present value terms. So the first step then is completed to have drawn the decision tree. This was a fairly straightforward one with only the 3 options to consider, so there wasn't much planning needed on this one. But you can appreciate as the scenario gets more and more complicated, there could be more arms and more branches to be drawn on our decision tree. What we have to do now then is to evaluate the decision tree, and to do that then we need to work from right to left. So the first thing that we've got then is to evaluate at point B. So we evaluate then using expected values. So if we do the major refurbishment then, we've got 2/3 chance of getting 13.5 million and a 1/3 chance of getting 6.5 million. But we also have to take off that then the costs of refurbishment, which are going to be 4 million. So 2/3 times by 13.5 million plus 1/3 times by 6.5. You can see here then that the major refurbishment gives us an expected value of $7.167 million. If we go for the cheaper refurbishment then and evaluate that one, we can see then the probabilities are the same, but it's 8.5 million if it's a good refurbishment that works well with good results, and 4 million if it doesn't work so well. The cost of this is only 2 million. So 2/3 times by 8.5 plus 1/3 times by 4 minus the 2 million, that's going to give us then 5 million. So we've got then our 2 different options to choose from, and we've also got the shutdown option for 5 million. What we're going to do though is we would want to choose to go for the major refurbishment on the basis of the expected values from the decision tree. Following on from the previous example then, we now have the opportunity to undertake some market research. The advantages of undertaking market research is that it gives you more of an idea of what the outcome will be and helps you to justify your decision. However, it's not 100% correct. So stepping aside from the lecture example for a moment, if you want to know whether or not to take an umbrella, you listen to the weather forecast. It gives you more idea than you would otherwise have, but it doesn't always guarantee to get it right. And it's very similar here with the market research. And you can see then that we're told that there's a 69% chance of receiving positive feedback and a 31% chance of getting negative feedback about whether or not the centre should be refurbished. The probability then of good outcome when the survey says it's going to be good is 91%. So just over 9 out of 10 times then, if the survey were to say that it was going to be good, then it would be. That means then that 9% of the time the results would actually be poor when the survey had indicated that they would be good. Similarly then, the probability of a poor outcome after negative feedback is 87%. So they're slightly less good then at predicting poor outcomes after negative feedback. If the survey then undertaken indicates that the response to the refurbishment would be positive, then they will go ahead with either the major or the cheaper refurbishment. If, however, the survey suggests that feedback is negative, we're told that they would only consider the cheaper refurbishment or closure. So there's clear indication then that the market research is going to guide their decision. Looking at the requirements then, we're asked to construct a decision tree to show the outcomes and the decisions that can now occur, and to calculate the value of the imperfect information. So what that means then is how much does the expected value increase as a result of having this additional information from the market research. When we're considering the different options then that can now occur, it's essentially the same as the previous example, where we can decide to close down the centre, undertake the major refurbishment, or undertake the cheaper refurbishment. The difference now then is that we have an additional option or an additional decision to consider up front, which is whether or not to undertake the survey. To show this then, what I'm going to do is to use the solution to the previous example and just build the survey into that. So you recognise this then as the previous example. I'm just going to call that A2 now because it is another decision that we've got here at A1, which is whether or not to undertake the survey. So here then we've got no survey, which is what we were looking at in the previous example. And then down here, we've got the decision to actually have a survey. So here then we've got the decision to actually undertake a survey. When we undertake the survey then, we could get positive feedback from the survey. If there's positive feedback, then we have a decision to make, and the decision then is whether to do a major refurbishment or whether to do the cheaper refurbishment. If we do the major refurbishment, the results could be good or they could be poor. And again, if we do the cheaper refurbishment, we could see good results or we could see poor results. If the survey then gives us negative feedback, we have a decision, but the decision here then isn't to have a major or cheaper refurbishment, it's simply to have the cheaper refurbishment or to actually go for closure. Remember, if we go for the cheaper refurbishment, we could get good results even though the survey wasn't expecting them, or poor results. Always a good idea then to draw them up, especially when you've got options whereby the results aren't always as expected, and then start to put on some figures. So good results then from a major refurbishment, same as before, 13.5 million. Poor results lead to 6.5 million. Cheaper refurbishment then, good results, 8.5 million. And poor results come in at 4 million. So 8.5 again, or 4 for the cheaper refurbishment. Closure then will still result in the 5 million. What we have to do now then is to look at the probabilities then of these occurring, I'm just going to write them on in a different colour so that you can see them. So the survey then had a 69% chance of giving us positive feedback and a 31% chance of giving negative feedback. But it doesn't always get it right. If it says it's going to be positive, then actually there's a 91% chance of it being good, which, as we said before, means there's a 9% chance of it being poor. When it says then that it's going to be negative feedback, the chances of it then being good are 13%, if the chances of it being poor are 87. So it's the 87 that's given to us in the question here for poor, and the 13% for good becomes the balancing figure, because they must always, remember, add up to 100%. What we need to start doing now then is to evaluate it in the same way as before. So we've got then an outcome here, a D, if we undertake the survey. We've got our decision to make then if the survey results are positive, and our decision to make if the survey results are negative. And then we've got our outcomes to make at the different points. So what we need to do now then is to evaluate the diagram and have a look at working out the expected values at the different points, the same as before then. So at point G then, there's a 91% chance of getting 13.5 million and a 9% chance of 6.5 million. So that gives us an expected value then of $12.87 million. At point H then, we've got again the 91% chance the outcome will be good, but because it was the cheaper refit, that only generates 8.5 of income, and the 9% chance then that we will get income of 4 million. So that gives us an expected value of 8.095. However, we need to think about what our decision is going to be at this point here at E. And so when we're looking at the decision at point E, we need to take into consideration the costs. So for the more expensive refit, the major refurbishment, that's going to be 12.87 million minus the cost of 4 million. And for the cheaper one, that will be the 8.095 minus 2. So we can see quite clearly then that our decision at point E is going to be to go for the major refurbishment. Need to consider then what our decision is going to be at point F as well. So we start off by working out the expected value at I, and there's a 13% chance of getting 8.5 million and an 87% chance of getting 4 million. So that gives us 4.585. Our decision at F then, without even really considering the actual costs of the cheaper refurbishment of 2 million, we can see we'll be far better off with closure, because its decision at F is basically 2.585 million or 5 million. So the decision at F would be closure. And that gives us 5 million of expected value. So we had then the results from the survey show us that there was a 69% chance that we're going to achieve the positive feedback, which gave us the 8.87 million, and a 31% chance then that we'll want to close down. So at D then, the expected value is going to be 0.69 times by 8.87 plus 0.31 or 31% chance times by 5 million, which gives us 7,670,000 1,300. What does that mean then? Well, if we go back and have a look then what that means for our decision, our initial decision at A1, if we didn't undertake the survey, remember then that we were looking at 7167. Undertaking the survey gives us 7670.3. So therefore our decision at A1 is going to be to undertake the survey. In part B, so the value of perfect information then, we look at the expected value with the survey, which we can just see here then is 7.6703 million. Compare that to the expected value without the survey, which was 7,167,000. And we can see then the value of the perfect information is just over £500,000. So the maximum then that you'd be prepared to pay for a survey would be £500,000. And the question could ask you to interpret what this value of perfect information is, and it's the maximum that you would be prepared to pay to get that information.
The next technique that we're going to look at in terms of dealing with risk and uncertainty in decision making is sensitivity analysis. Now, this is something that you will look at again in paper F9, and what we're looking at here is assessing a decision in terms of what if something changes. So what if analysis, if you like. So what we can do, for example, is to calculate the maximum percentage change in a variable before the decision would change. So let's say that you're making a decision to go ahead with a product, but you know that material costs potentially could affect your decision. If they go up too much, you won't actually make that product. So what you could work out is by how much can material costs go up before you won't make it. So again, similar sort of idea. Would your decision change if the variable changed by a certain percentage of the estimate? So same sort of idea there. Alternatively, let's say you've got two options, project A or project B, and you could estimate by how much the costs or the revenues would need to change before one becomes the same as the other. So given the current circumstances, you'd choose project A, but if something changed, how much would it need to change before project B becomes just as good? Gives you more information, then it makes you a better informed decision maker. So taking the by now hopefully usual approach to F5, what we're going to do is to look at how the calculations are done, how the technique works, and then examine what the possible limitations could be of using this approach. So in terms of the technique, here we've got a company that's going to launch a new product, and we've got some financial information about sales, materials, labour, and what you can see is that they are expecting to make a profit of 20,000 from this particular product. And what we're going to look at is by how much would materials have to change in order for that product to become non-viable, or the units sold. Units sold, slightly more complicated, so let's start with the easier one first of all, the material costs. Materials at the moment cost 20,000. So by how much would they have to go up before you were breaking even? In other words, just before you start to make a loss. Well, this one's quite an easy one to spot really, because if you've only got 20,000 profit, your material costs would have to double. So no nasty maths here at all, just a statement of common sense really, straight from the information in the question. If material costs were more than double the original estimate, the product would make a loss. So looking now at units sold, and hopefully you're starting to think in terms of this must have something to do with the break-even analysis that you did earlier in the course. So if we're talking break-even analysis or any form of decision making, what we are concerned about always is the contribution that you are getting from this particular project. So the contribution here is the sales price of 10, take off the variable costs, so we've got 2 and 3, material and labour, giving us a contribution per unit of $5. Now what you've got to think is, okay, so you're getting a profit of 20,000. How many units does that equate to? So a profit of 20,000, obviously once you've already covered your fixed costs, but a profit of 20,000 is the equivalent of 20,000 divided by 5, which is 4,000 units. In other words, sales would have to fall by over 4,000 units in order for the product to make a loss. So we can put that into a sentence, and you can also do it in terms of a percentage as well. At the moment, they're predicting that they're going to sell 10,000 units. So if it fell by 4,000, it would fall to 6,000 units. So sales in total would have to fall to 6,000 units, and that is a 40% fall. Then the next thing to do would be to assess whether or not that's significant. Is it likely? Do we need to be worried about it? Now obviously this is really quite useful analysis. The better the information, the more the information, the better the decision. But again, as usual, we need to think about the limitations of this. And what you can see is that you're only testing one variable at a time, and there could be interactions between them. There's no actual decision rule. It doesn't tell you do this or do that. It just gives you more information. And really, quite importantly, all the things that we've been doing so far, we've been talking about probability. But we don't know how likely it is that sales might fall by 40% or how likely the materials might double. So probability would be more useful, or perhaps even a combination. So let's just review these various techniques that we've covered so far. High-low method should be very familiar and absolutely essential that you're able to do this one. It's used a lot in F5. There's an assumption that you can just do it. Total cost function is the first time that we look at the equation of a straight line. Linear regression uses that equation of a straight line and talks about the relationship between two variables and then to forecast it with those nice interesting formulae in there. We can also use time series analysis to forecast, and that focuses on particularly the trend and the seasonal variation. And then finally we looked at the simple average growth model, looking at growth rates calculated on past data and then using that to forecast future periods.